There are movements in geopolitics that never make the breaking news, never generate sensational headlines or tense moments in front of television cameras. They unfold quietly in closed-door meetings, within hundreds-page-long investment memorandums, and on diplomatic trips whose itineraries are themselves messages. This is diplomacy without gunfire, yet powerful enough to shift the balance of power in steady, irreversible ways. On January 8th, 2026, when Canadian Prime Minister Mark Carney declared that his country was building a dense new network of connections to attract investment, diversify trade, and create a more independent economy, many might have dismissed it as typical policy language. But in geopolitics, what matters isn't just the words, it's the context and the chain of actions that follow. In less than 2 weeks, he completed a visit to Beijing, prepared to fly to Qatar, marking the first time a sitting Canadian Prime Minister had ever set foot in the Gulf nation, and then on to Davos, the global epicenter of financial elites. This wasn't just a diplomatic itinerary, it was a strategic flight path, calculated down to the detail. While Canada quietly expands its strategic options, Washington is sending out signals that move in the opposite direction. Tariffs are being deployed as tools of pressure. Remarks about a 51st state cast a cloud of uncertainty over a long-standing alliance. A power logic driven by short-term pressure and domestic political calculus is now being applied even to its closest partner. History shows that when pressure exceeds the limits of tolerance, nations rarely yield. They adapt. They find another path. And in the 21st century, that path doesn't have to go through military alliances or declarations of confrontation. It can lie in changing the sources of capital that fuel their economies. Canada understands that autonomy doesn't just come from policy, it comes from who holds the long-term financial levers embedded in the structure of the national economy. It is at this point that the Middle East, specifically the Gulf region, enters the picture, not as some distant partner, but as a strategic resource. Sovereign wealth funds managing trillions of dollars with decades-long visions and free from the American electoral cycle are emerging as new power centers in the global order. As the flow of capital shifts, so too does the balance of power. To understand why Canada's pivot carries such weight, and why Gulf names are showing up with increasing frequency in global strategic calculations, we need to confront the defining question of our time. Ultimately, who really holds the power? To answer the question of who truly holds power in the 21st century, we must set aside familiar images of defense budgets or the hotly debated stimulus packages in parliaments. Power today operates on a quieter, longer-term, and far less reversible logic. It rests in the hands of entities capable of deploying capital at a national scale, with a vision that stretches far beyond a single political term. These are the sovereign wealth funds. And among them, the Gulf region is rising as a true financial power center in the emerging global order. In just the first 9 months of 2025, sovereign funds from the Gulf Cooperation Council poured over $56 billion into nearly 100 deals across the world. That figure is not only large in absolute terms, but also reflects a deeper shift. Nearly 40% of all sovereign state investment worldwide during that period came from this region. The total assets they manage have surpassed $5.6 trillion, and even the most conservative forecasts predict that number will approach $9 trillion by the end of the decade. But the real story isn't in the scale, it's in how that capital is being used. Unlike traditional financial funds driven by short-term profits and market pressures, Gulf sovereign funds operate on a different timeline. They don't buy stocks to ride short-term waves or chase immediate price jumps. They build systems. They invest in infrastructure, energy, logistics, foundational technologies, the kinds of assets that shape economic power over decades, not just a few fiscal quarters. While commercial banks must recycle capital within credit cycles, these funds are willing to wait 30 or even 40 years for returns. For them, long-term stability is far more valuable than short-term yield. Because of that, they seek countries capable of delivering that rare certainty, a legal system that's predictable, a political climate not jolted by extreme electoral shocks, a society stable enough for infrastructure projects to last across generations. In an increasingly volatile world, Canada comes close to ticking every box. And here lies the paradox. Canada isn't attractive because it's close to the US, but because it's just far enough from the growing political chaos across the border. This also explains why Gulf funds are gradually rebalancing their portfolios. They aren't turning their backs on the US, but they no longer want to be overly dependent on a system where policies can shift overnight due to domestic political mood swings. When tariffs are wielded as weapons, when even allies can be openly pressured, such volatility becomes an unacceptable risk for investments meant to span half a century. Risk mitigation in this case doesn't mean retreat, it means diffusing power. And as capital begins to seek safer harbors, it doesn't flow randomly. It gravitates towards sectors that can multiply power in the future. In this picture, one field stands out as both symbolic and decisive: artificial intelligence. Not AI as a consumer app, but AI as the infrastructure of the 21st century. Data centers, compute capacity, energy supply, and legal frameworks that allow these invisible factories to operate for decades without becoming politicized. When Gulf funds look at Canada, they don't just see a stable country. They see the ideal foundation for laying the first bricks of tomorrow's technological infrastructure. And it is at this very intersection that sovereign capital begins to transform into a tangible strategic lever, with artificial intelligence emerging as the clearest and most deliberate first step in a growing alliance between Canada and the Gulf. If the wave of sovereign capital needs a fulcrum to transform from an abstract concept into tangible power, then artificial intelligence is precisely that fulcrum. Not because AI is a trendy buzzword, but because it is one of the rare fields that brings together all three pillars of 21st century power: physical infrastructure, long-term horizons, and the ability to create strategic dependency. When Gulf funds look at Canada, they're not searching for a lab or a startup. They're looking for a place to build the factories of the future. In December 2025, when Qatar's sovereign wealth fund announced the creation of a dedicated AI division, the move barely made a ripple in the public eye. But just days later, news of a $20 billion joint venture with a Canadian partner began turning heads in the financial world. This wasn't a typical venture capital bet. It was a long-term commitment to AI infrastructure: large-scale data centers, stable power systems, land, cooling, and compute capacity at a national scale. In other words, it was a decision to lay the groundwork for technological power that could last for decades. Within this picture, Canada possesses a nearly unmatched set of advantages. Abundant electricity from hydro, nuclear, and natural gas ensures a steady supply for energy-hungry data centers. Its naturally cool climate dramatically lowers cooling costs, a seemingly minor factor, but one that determines long-term operational viability. Its legal system is strong enough to protect assets and intellectual property, yet not so volatile as to become a political risk. And most importantly, Canada's political environment doesn't turn AI into a pawn in short-term domestic squabbles. For Qatar and other Gulf sovereign funds, investing in AI in Canada isn't merely about returns. It's a form of strategic insurance. It gives them access to advanced technological infrastructure without placing their entire trust in a single system where the rules can change with every electoral cycle. As data, compute power, and algorithms become the new strategic resources, controlling where that infrastructure sits becomes just as crucial as controlling oil fields once was. For Canada, this marks a structural turning point. For the first time, it can build global-scale AI infrastructure without relying on American banks, without waiting for political approval from Washington, and without the geopolitical strings that usually come attached. When the capital comes from the Gulf, AI is no longer a field pulled into superpower rivalries. It becomes the foundation for endogenous economic development. Once these data centers are built, they'll remain for decades, generating jobs, supply chains, technological capabilities, and a quiet but lasting form of influence. At a deeper level, AI also introduces a new kind of dependency. Businesses, financial systems, even government agencies will increasingly rely on this compute infrastructure to function. In that context, power no longer lies in who writes the algorithms, but in who owns the platform that allows those algorithms to exist. And when that platform is funded by sovereign capital outside the US system, the ability to exert external pressure diminishes significantly. But as vital as artificial intelligence may be, it cannot exist in a vacuum. These massive data centers require stable electricity, minerals for hardware, and logistics infrastructure to operate. AI is simply the most visible tip of a much deeper power structure. Beneath it lie the backbones rarely mentioned in tech debates, yet critical to everything: energy, minerals, and infrastructure. It is here that the wave of Gulf sovereign capital doesn't stop at technology. It begins to spread into even more foundational sectors. Because for technological power to be sustainable, it must be anchored in irreplaceable physical resources. And that is when the story shifts to a deeper layer, where Canada's energy, minerals, and infrastructure become indispensable pillars of a new balance of power now taking shape. When the shine of artificial intelligence is peeled back, what remains of power takes on a more familiar, yet far more enduring and decisive form. No data center runs without electricity. No digital economy expands without metals, minerals, and the physical infrastructure to support it. And it is at this deeper level that energy, minerals, and infrastructure become the true backbones of 21st century power, where Gulf sovereign wealth funds see their most enduring value in Canada. For over a decade, Gulf capital has quietly flowed into Canada's energy sector. At first, it was the usual investments in oil and gas, offshore projects, and cash-generating assets. But that logic is shifting. As the world enters a new era of energy transition, sovereign funds understand clearly. Power no longer lies in how many barrels of oil are sold today, but in who controls the energy systems of tomorrow. From carbon capture to hydrogen and large-scale renewables, Canada stands out as one of the rare places where this transition can unfold slowly, orderly, and profitably over the long term. What makes Canada especially attractive is not just its natural resource reserves, but its ability to combine extraction with governance. A stable electricity grid, clear environmental regulations, and high technical capacity allow energy projects to proceed without political disruption. For Gulf funds, this is a stark contrast to many other parts of the world where energy is synonymous with instability. In Canada, energy is not a source of risk. It's a foundation for building long-term economic power. Strategic minerals are the next critical piece. Lithium, nickel, cobalt, rare earths, once confined to technical reports, are now front and center as geopolitical resources. They determine the ability to produce batteries, electric vehicles, energy storage systems, and the full spectrum of advanced technologies. Canada holds significant reserves, but more importantly, it has one of the world's most advanced financial and technical mining ecosystems, capable of transforming raw resources into long-term value chains. For Gulf nations, investing in Canada's minerals isn't just about portfolio diversification. It's a way to shift power from markets to sources. Rather than being subject to volatile commodity prices, they gain control of the supply chain at its origin. As the world races to secure inputs for the green transition, owning the mines, the extraction technologies, and the transportation infrastructure becomes an irreplaceable strategic advantage. Infrastructure, though rarely in the spotlight, is where sovereign capital shows its clearest strength. Ports, railways, power grids, telecom networks, logistics hubs, all require immense capital, long-time horizons, and a level of patience few private investors can offer. But for sovereign funds, this is familiar ground. A port built today will operate for half a century. An upgraded power grid will shape the economic architecture of an entire region. When infrastructure in Canada is backed by Gulf capital, the relationship is no longer a short-term contract. It becomes a strategic bond lasting across generations. At the deepest level, energy, minerals, and infrastructure generate something that AI or advanced tech cannot produce on their own: stability. It's the ability to sustain economic activity despite external political shocks. It's the foundation that allows a nation to say no to pressure without paying the price of internal disruption. And it is this stability that makes Gulf investments fundamentally different from most other capital flows into Canada. When all the pieces come together, the picture becomes clearer. AI is the symbol, energy is the foundation, minerals are the raw inputs, and infrastructure is the skeleton that holds the entire system together. These aren't isolated investments, they're part of an intentionally constructed system. And once that system starts to function, the numbers attached to it are no longer symbolic. That's when the question is no longer how much capital Canada can attract, but why a number like $95 billion appears so naturally in every strategic calculation. Because when we examine the scale, the rhythm, and the underlying logic of the sovereign capital now shifting course, $95 billion isn't a political ambition. It's the inevitable result of a new power structure slowly taking form. The figure of $95 billion when viewed in isolation can easily be misunderstood, dismissed as a flashy political statement or a media-friendly target designed for effect. But in geopolitics, numbers that truly matter rarely appear by accident. They are the product of cold calculations, of capital flows, of absorptive capacity, and of time. When we look at how Gulf sovereign wealth funds operate, $95 billion isn't ambition. It's a perfectly reasonable scenario. Every year, these funds deploy tens, sometimes hundreds of billions of dollars across global markets. This isn't capital chasing quick returns. It's capital seeking structure. If Canada were to become the destination for just 15 to 20% of that annual deployment over the span of 5 to 7 years, the $95 billion figure would almost form on its own. No single breakthrough deal required. No grand announcement. It would be the result of a steady stream of projects: data centers, energy infrastructure, strategic mining, ports, logistics, and industrial support systems. What matters even more is the nature of this capital. This is not hot money that flees with rising interest rates or market volatility. This is capital tied to concrete, steel, power lines, mining sites, and immovable systems. Once deployed, it creates a physical presence that lasts for decades. And it's that presence, not the number, that shifts the balance of power. When AI infrastructure is built with capital from outside the US system, when energy and strategic minerals are funded by entities free from Washington's political cycles, Canada enters an entirely different position. Tariffs lose effectiveness as tools of coercion. Short-term pressure can no longer shake structures locked in by long-term capital. Choice appears, and in geopolitics, the ability to choose is the foundation of true sovereignty. The $95 billion figure also reflects another reality. This is not replacement, but strategic addition. Canada isn't cutting ties with the US or abandoning the North American market, but as sovereign wealth begins to flow in, the US ceases to be the only door. And when a country is no longer confined to a single path, all of its relationships become more balanced. Dependence lessens, bargaining power rises, and the space for independent policy expands. At a deeper level, this number carries both psychological and strategic weight. It signals that Canada is now large enough, stable enough, and attractive enough to anchor long-term capital in an uncertain world. For Gulf funds, it's a way to spread risk beyond the traditional power centers. For Canada, it marks a shift from being a northern appendage in a north-south economic flow to becoming a strategic node in a truly global capital network. When viewed across the entire landscape, the question surrounding $95 billion is no longer if it can be reached, but when and in what form. Because once the logic is in place, capital will move to make it real. And once those investments materialize, Canada won't just gain capital, it will gain time, options, and the ability to shape its own economic destiny. In a world where power is increasingly measured by the ability to remain stable, not by the ability to shock, $95 billion is not a finish line. It is proof that Canada has entered a new era, one in which power is no longer seized through pressure, but built through structure, through patience, and through financial decisions deep enough to shape generations to come. Geopolitical history rarely unfolds the way power centers intend. The very tools designed to impose order often end up triggering transformation. Pressure, when overused, doesn't cause smaller nations to submit. It forces them to think differently, plan further ahead, and seek exits they never previously prioritized. Canada's story in this moment is a textbook example of that paradox. In trying to preserve its influence through tariffs, uncertainty, and political pressure, Washington has unintentionally pushed Ottawa into a profound process of strategic repositioning, not through confrontation, not through bold declarations, but through quiet decisions involving capital flows, infrastructure, and time. Canada isn't trying to challenge a superpower. It's simply refusing to be locked into a single framework of dependence. The investments from the Gulf, once deployed, don't vanish with an election cycle or a presidential term. They remain in the concrete of data centers, in the power grids fueling entire economic regions, in the mines that sustain the global tech supply chain. 30, 40, even 50 years from now, those structures will still be there, continuing to generate value and influence. And with them, a Canada that has more options, more policy space, and greater leverage in every relationship. It's important to emphasize this isn't a story of confrontation between power blocks. Canada isn't turning its back on the US or on North America. What's happening is adaptation. In a world where capital and technology move faster than ever, the nations that can intelligently restructure their dependencies are the ones that will retain real sovereignty. Not sovereignty in name, but sovereignty backed by the ability to say no without paying the price of economic collapse. In this case, pressure has opened an exit, not one of retreat, but one leading toward a more balanced power structure. Canada is learning how to operate in a global order where no relationship is permanent, where stability is the most valuable strategic asset, and where long-term capital matters more than short-term political declarations. When we step back and view the full picture, what lingers is not the $95 billion figure, nor any single diplomatic trip or investment deal. What remains is a deeper lesson about the 21st century. Power is no longer defined by how quickly one can apply pressure, but by how durably one can build structure. And in that game, those who know how to harness time, capital, and patience will be the ones shaping the next global order. If you have your own perspective on Canada's pivot, the role of sovereign capital, or how power itself is being redefined in today's world, share your thoughts in the comments below. These conversations are how we deepen our understanding of the shifts shaping our future. And if you found this analysis valuable, don't forget to subscribe to the channel for more geopolitical stories where power moves in ways few ever expect.